3 years ago, a warehouse worker named Ronald Reed died at 92. His family expected maybe $50,000 in his will. They found $8 million. He never earned more than $11 an hour. He did one thing, just one. I'll show you exactly what it was. Here's what's happening to most people right now. You've heard you should invest. You've Googled it. You've gone down rabbit holes about stocks, crypto, real estate. Your money just sits in a savings account, earning nothing while inflation eats it every single month. The solution is one of the simplest ideas in finance. No spreadsheets, no financial degree. It's called an index fund. And Ronald Reed used it to quietly build $8 million on a warehouse worker's salary. Think of it like a restaurant. Option A, you pick one dish. If it's bad, you're stuck. Option B, you get a tiny taste of every dish on the menu. And fund is option B for the stock market. An S&P 500 index fund gives you a piece of the 500 largest companies in America. Apple, Microsoft, Amazon, Google, Tesla, all of them. One purchase. In 2007, Warren Buffett bet $1 million that a simple S&P 500 index fund would beat the world's best hedge funds over 10 years. 10 years later, the index fund returned 125%. The hedge funds averaged 36%. Buffett by a landslide. 3 reasons index funds are so powerful. First, fees. Actively managed funds charge 1 to 2% per year. On $100,000 over 30 years, that's $150,000 gone in fees alone. An S&P 500 index fund costs as little as 0.03% per year. Almost nothing. Second, diversification. You're not betting on one company surviving, you own all 500. Blockbuster collapsed. Kodak collapsed. Nokia collapsed. The market rising because winners replaced them. Third, simplicity. You buy, you hold, you add regularly. That is the entire strategy. Now, the math that will change how you think about money forever. $10,000 invested at 10% annual return, the historical S&P 500 average. After 20 years, $67,000. After 30 years, $174,000. You put in $10,000, you did nothing else, you end up with $174,000. 3 mistakes to avoid right now. 1. Choosing index funds with high fees. Always check the expense ratio. Never pay above 0.2% for a basic index fund. 2. Selling during a crash. Every single crash in history was followed by full recovery and new all-time highs. The people who lost money permanently were the ones who panicked and sold. 3. Waiting for the right time to start. There is no right time. Every month you wait is compound growth you never get back. Your action step today: open your brokerage app. Trading 222 is linked in the description, and search for VOO. That is the Vanguard S&P 500 ETF. Look at the 10-year chart. Look at the expense ratio, 0.03%. That is your benchmark for every investment you ever consider. And if you want to go deeper, The Intelligent Investor by Benjamin Graham is the book that started it all. Link in the description. Now, I want to hear from you. What is the one thing stopping you from investing right now? Is it not knowing to start, not having enough money, or not trusting the market? Drop it in the comments. I read and reply to every single one. Subscribe for a new video every single week. See you next Monday.